Welcome to the deep dive. We're here to take complex topics and, well, really break them down so you get the core knowledge fast. Today, we're diving into something pretty fascinating in the world of institutional trading. Sort of pulling back the curtain a bit, we're going to do a beginner level deep dive into market structure and those key ideas from ICT and SMC, inner circle trader, smart money concepts. So if you're maybe prepping for a meeting or you just want to get beyond the usual retail trading stuff, this should be really helpful.
That's absolutely the plan. Our mission really is to take these, let's say, high-level institutional ways of looking at the market and boil them down into something clear, structured, something you can actually use. If you've ever watched the price move and thought, is this random? Or maybe even felt like the market's out to get your stop loss. Well, yeah, we want to give you the tools to understand the why behind price action, especially understanding liquidity and where the market's likely headed.
Yeah, that focus on why, on the intent, I think that's crucial. Let's get right into it then. Our sources are really clear on this. Market structure isn't just one piece of the puzzle, it's basically the foundation. So let's unpack that. What exactly is market structure when we talk about it in this context?
Okay, so market structure, fundamentally, it's just the way the market evolves based on the highs and lows it creates. We call these swing highs and swing lows. It's this sequence, this kind of rhythm of peaks and valleys that defines everything. It's non-negotiable, really.
And you're saying this is the single most important thing, more important than indicators or anything else. Why is it so definitive?
Because it's the only thing that truly defines the trend, the current direction of the market. It's that simple. Look, if the market keeps making higher highs and then pulling back to make higher lows consistently, well, the trend is up, period. Any move downwards, no matter how sharp it looks, is just a pullback or retracement until that underlying pattern of higher lows is broken. So knowing the structure tells you the main bias. And trading without that bias, honestly, it's more like gambling.
Okay, so if we want to trade with the structure, step one is accurately spotting those turning points, the swing highs and swing lows. How do we know if it's a real significant swing point and not just, market noise?
Right, good question. You need a visual confirmation, and it comes down to a specific three-candle pattern, very precise. For a swing low, you need that V shape. The middle candle, and we're talking about the low point of its wick, that low must be lower than the low of the candle just before it and lower than the low of the candle just after it. It has to be the absolute lowest point in that little three-candle group.
The valley. And for a swing high, it's the opposite, right? The A shape. You mentioned a hat earlier.
Exactly, yeah, the A shape or the hat. For a swing high, the middle candle's wick has to be higher than the wicks of its immediate neighbors, the highest point. And these points are so critical because they mark the exact spot where the next push, the next expansion or impulse move really kicked off from. When we're trying to figure out where price might turn around, we look back at where the last big move started. So if you see a clear, confirmed swing low form right near a level you already identified as important, well, that's a big signal. It tells you the next major push might be starting right there.
That three-candle rule seems vital, then, for filtering out all those little insignificant wicks that don't really mean anything institutionally. Okay, so let's say we've identified a trend, higher highs, higher lows. It's clearly going up. What happens when that pattern breaks? What are the terms the institutions use for that kind of shift?
Okay, yeah. We have specific terms because the type of break matters. If we're talking about a potential major shift, maybe the very first sign of weakness, you'll often hear change of character. That's CHOCH, sometimes spelled COCH. This is usually the first warning. It might happen on a lower time frame, or maybe it just breaks a less important internal swing point. It suggests a change might be coming, but it's not definite yet.
So CHOCH is like the early warning flare. Could be just a quick dip to grab liquidity or a minor wobble, but not necessarily full trend reversal yet.
Precisely, it's a heads up. The stronger term, the one that confirms a more serious commitment, is the break of structure, or BOS. A BOS means the market is really committed. Either it's continuing the existing trend strongly, or it's signaling a major reversal of the higher time frame trend. So, in our uptrend example, a bearish BOS would be confirmed only when the price breaks below the last significant swing low that was protecting that uptrend structure. The key, protected low.
Okay, and this brings us to confirmation. This seems like a point where beginners often get tripped up. What makes a BOS confirmed? Is it enough if the price just wicks below that low?
No, absolutely not. And this distinction is critical. It filters out a huge amount of fake outs. For a confirmed BOS, you need a clear, undeniable break of that key level. And crucially, the body of the candle has to close decisively past that previous high or low. A wick that just pokes through and then snaps back. That's usually a liquidity grab, not a confirmed structure break. We need commitment.
Let's pause there because I think that's exactly where people get caught. Why is the candle body closing past the level so important in this institutional view?
Because the body represents where the bulk of the volume traded, where the commitment lies. Think of it as institutional weight. A wick shows rejection. Price went there briefly, maybe triggered some stops, grabbed liquidity, but it was immediately pushed back. There wasn't enough conviction to stay there. But a body close, especially a strong candle, with a big body closing past the level, what we call displacement, that shows real momentum. It's just the intent to continue in that new direction is genuine. When you see that clean body close past a key structural point, you know the larger players are likely involved and committed. You're aligning with their intent, not just reacting to noise.
Right, so understanding these confirmed breaks based on body closes is really the starting point for anticipating the next big move, especially, like you said, when that confirmed swing point or break happens near a zone we've already marked as significant.
Exactly. It's about putting the pieces together. Structure gives you the map, the overall direction.
Okay, so if structure is the map, then liquidity, you're saying that's the fuel, the engine driving the whole thing. Our sources really hammer this home as maybe the most important concept in SMCICT.
It absolutely is. Liquidity is the smart money concept, fundamentally. Think about it. Institutions, these guys trading billions, they have a massive problem retail traders don't. They need someone to take the other side of their huge trades. They can't just click buy on $1 billion worth of euro without finding sellers willing to offer that much at that price, right? They need counterparty volume.
Which means they can't just enter anywhere they want. They have to be strategic, almost predatory about finding that volume.
Exactly. It's a zero-sum game. For them to make $1 billion, someone else or many someone else's have to lose that billion collectively. So to fill these enormous orders without moving the price against themselves too much, they have to seek out places where large pools of orders already exist, ready-made counterparties. And this need dictates where price moves. It's not random. Price is drawn to where the liquidity is concentrated.
So the million-dollar question, where does this liquidity typically pool? Where are the easiest spots for institutions to find these counterparties?
It hides in plain sight, usually. The most obvious places are just behind the recent significant swing highs and swing lows. The extremes. Why? Because that's where conventional trading wisdom tells everyone else to put their stop losses. Think about it. If you're selling, you put your stop loss just above the recent high. If you're buying, your stop goes just below the recent low. Our source material couldn't be clearer on this. Stop losses, liquidity. Those clusters of stops are like magnets for institutional orders.
Ah, so this explains that incredibly frustrating experience, right? Getting stopped out by a wick, or sometimes called a turtle soup or a liquidity sweep. I think every trader's felt that pain. You get wicked out by a few pips, and then bam, the price reverses and goes exactly the direction you predicted.
That feeling isn't just bad luck. It's literally the footprint of an institution at work. That liquidity sweep, that wick, is often smart money intentionally pushing price just far enough to trigger those clusters of stop losses. They need those stops, which are essentially market orders waiting to be filled to get their own massive positions filled at a better price before they initiate the real move. Once they've absorbed that liquidity, grabbed those stops, the counterpressure is gone, and they can drive the price where they intended much more easily.
Okay, but here's the skeptical question then. If we know the stops are likely there, and presumably the institutions know that we know, how do we tell the difference? How do we know if it's just a quick stop run, a liquidity sweep, versus a genuine break of structure where the trend actually is changing? How do we avoid getting swept ourselves?
That's the million-dollar filter, isn't it? And the answer comes back to what we just discussed. Structure confirmation and the time frame. A genuine break of structure, BOS, needs that candle body to close past the level, especially on a reasonably high time frame like the 1 hour or 4 hour. That shows commitment. A liquidity sweep, 9 times out of 10, will just pierce the level with the wick. The candle body will then close back within the previous range or back below the high above the low it just violated. So if price wicks you out, but the candle closes back in your favor, that's a huge clue. It suggests the intent was just the sweep, not a sustained move against you.
Okay, that connects perfectly back to section 1. Structure confirmation is key to interpreting the liquidity grab. Let's talk about specific places where liquidity tends to build up even more. Obviously, we see these patterns repeat.
Yeah, there are a few classic setups institutions love to target. First, you have equal highs or equal lows. This is when you see 2 or more peaks hitting roughly the same price level, or 2 or more troughs bottoming out at the same level. Retail traders might call it a double top or double bottom and see it as resistance or support. Institutions see it as a big flashing sign saying lots of stops parked right here. It's a prime target for a run on stops.
Makes sense. The second one you mentioned is the classic trend line.
Oh yeah, trend lines are fantastic targets. Why? Because they're taught everywhere as simple entry points. People draw a line connecting the lows in an uptrend, wait for price to touch it again, and buy, putting their stop just below the line. This creates a neat diagonal line of stop losses just sitting there, building up with each touch. Institutions see that as an easy pool of liquidity to sweep before potentially continuing the trend or reversing it.
And the third one sounds a bit more subtle. Inducement liquidity. What's the idea behind this trap?
Inducement is a bit more advanced. It's where the market deliberately creates a small, seemingly attractive price level before reaching the real target zone. It's designed to induce less patient traders, the FOMO crowd, to jump in early or place their stops in a vulnerable spot. Basically, the market creates bait before going for the real move.
Can you walk us through an example? Like, what would that look like on a chart?
Sure. Imagine you're bullish, you accept the price to go up, and you've identified a really strong order block way down in the discount zone. We'll get to those terms soon. But before price gets down there, it rallies just a little bit, forms a small, minor swing low that's still quite a bit above your target order block, and then pulls back slightly from that minor low. That minor swing low is the inducement. Early buyers see it and think, oh, look, a pullback, it's cheap now. They buy there, placing their stops just below that minor low. What happens next? Smart money often pushes the price down past that inducement low, triggering all those early stops, grabbing that liquidity. And then it finally reaches the deeper, true order block you were patiently waiting for, fills its main orders there, and then launches the real move upwards. The inducement level was just a stepping stone to fuel the real entry.
Wow. Okay. So the underlying principle for us, the learner, is to constantly think. Price isn't just wandering around. It's actively moving from one pocket of liquidity to the next.
That's the engine. The whole market dynamic, session by session, day by day, is this continuous, intelligent hunt for liquidity to facilitate institutional order flow. If you understand the hunt, where it's likely going, and why you're way ahead of the game.
All right, so we have the direction from structure and the fuel from liquidity. Now we need the where, the precise zones for entry. This brings us to PD arrays.
Exactly. PD array stands for Premium Discount Array. The array part just means the set of specific tools or reference points we look for within that premium discount context. These are localized attack zones, specific points of interest on the chart where we can strategically plan an entry, usually after we've seen a clear break of structure or a significant liquidity sweep. We'll focus on two of the most reliable ones, the fair value gap and the order block.
Okay, let's start with the fair value gap, FVG. I noticed our sources sometimes used other names too, like busy or CBI. Can you clarify that?
Yeah, you'll hear different terms depending on the mentor or source, but they generally point to the same thing. FVG is the most common. Some might call it a busy, that's B-I-Z-Y, balance and inefficiency zone yield, or a CBI, consolidated block imbalance. But essentially, they all describe a gap or a hole in the price action. You spot it by looking at a sequence of 3 candles. The key is that the wick of the first candle in the sequence does not overlap with the wick of the third candle. There's a literal gap between them.
That non-overlap is the defining feature. What does it tell us? What does that gap signify?
It signals a moment of extreme imbalance or inefficiency in the market, usually caused by very aggressive, one-sided buying or selling. For instance, in a really strong, fast move up, the buyers were so dominant that there were hardly any sellers participating in that specific price range. It left behind an unfilled or unmitigated zone.
And the market tends to revisit these FVGs, right? Why does it often pull back into that gap?
Well, the market generally seeks efficiency and balance. So these FEGs tend to act as magnets. Price often returns to rebalance or reprice that inefficient area. It's like the market needs to go back and allow the other side, the sellers, in our bullish example, a chance to participate at those levels where they were previously overwhelmed. This return to the FEG is often a high probability entry point.
Okay, but not all FEGs are created equal, I assume. How do we filter for the ones that are most likely to hold as support or resistance?
Context is everything. The highest probability FEGs are the ones that form immediately after a confirmed break of structure, BOS, or right after a major liquidity sweep. And critically, you want to see that the FEG was created by displacement, meaning strong, large-bodied candles, usually all the same color, showing real power and institutional intent behind the move that created the gap. A tiny little FEG formed during choppy consolidation. Much less reliable. Look for the ones created by force.
Got it. Displacement is key. Now let's move to the other classic PD array, the order block, or OB. How do we define that precisely?
An order block is typically defined as the last opposing candle right before a strong, impulsive move that breaks structure. So if you have a powerful move up that breaks a previous high, a bullish BOS, the order block is the last bearish candle just before that big upward explosion started. The thinking is that this last down candle was the zone where institutions finish accumulating their buy orders before launching the move. So when price returns to this zone later, it often finds support. The opposite is true for a bearish move, obviously the last bullish candle before the drop.
Okay, now this seems like a good place to bring in some finer points.
Hmm.
The sources mention variations like mitigation blocks and breaker blocks. This feels important for moving beyond the basics.
Absolutely. These add necessary nuance. So the standard order block OB is just that last opposing candle before the break. Simple. A mitigation block, MB, is basically an OB that price has already come back to and tested once. Let's say it was resistance, price hit it, bounced off, and then later price comes back to that same level again.
Huh.
That second test is mitigating the remaining orders before maybe continuing down. It's a retest scenario.
And the breaker block B, that's when the OB doesn't hold, but it still tells us something important.
Correct. A breaker block is an order block that failed. Simple as that. If an OB was supposed to act as support, but price slices right through it and, crucially, closes decisively below it with the candle body, that OB is broken. But it doesn't just disappear from relevance, it flips its role. That old support level, the broken OB zone, now becomes resistance when price pulls back up to it. Seeing an OB break and then act as the opposite SR level is a very strong signal that the market's intent has fundamentally shifted.
That's a powerful concept to flip. The sources also had a practical tip for when the price action looks messy around a potential OB, maybe lots of small candles.
Yes, this comes back to the fractal nature of the market. If you're looking at, say, a 15-minute chart, and the area where you expect an OB just looks like a jumble of small up and down candles. Zoom out, check the 1 hour, the 4 hour, maybe even the 8 hour, 12-hour chart. Often, that messy consolidation on the lower time frame resolves into one single, clear, well-defined order block on the higher time frame. Much easier to identify and trade. Always seek clarity.
Great tip. And lastly, under this section, we have the inverted FVG, IFVG. Same logic as the breaker block.
Exactly the same logic, just applied to the fair value gap instead of the order block. If you have an FVG that was acting as, say, support and then price trades down through it and gets a solid candle body close below the gap, that FVG has failed. It's been invalidated.
Right.
But just like the breaker block, it flips its role. That broken FVG zone now tends to act as resistance on the next pullback. Both the breaker block and the inverted FVG are strong signals because they show the market not only failed to respect a previous point of interest, but actively violated it, indicating strong conviction in the new direction.
Okay, that covers the specific zones. Now, section 4 adds a crucial layer of context. Basically, when is it smart to even look for an entry in those zones? It boils down to a business principle.
Yeah, this is fundamental. Smart money, institutional money, they have one basic business principle. Buy low, sell high. Buy wholesale, sell retail. As traders trying to emulate their success, we absolutely have to adopt the same mindset. We want to buy assets when they're cheap, when they're effectively on sale, it's the discount zone, and we want to sell assets when they're expensive, when they're overpriced. That's the premium zone. If you try to buy when the price is already way up in the premium zone, your risk is just way too high. You're basically buying at the top, right before a likely pullback.
Makes sense intuitively, but how do we define cheap and expensive objectively on the chart? We can't just guess.
We use the Fibonacci retracement tool.
Yeah.
But, and this is important, we don't just slap it on anywhere. We apply it specifically to the range of the most recent confirmed impulse leg of the market structure. So from the confirmed swing low that started the move up to the confirmed swing high where it paused or peaked. That's the range we measure.
And within that measured range, what's the key dividing line?
The 50% level, that's the midpoint, the equilibrium price for that specific move. Anything above the 50% line is considered the premium zone. It's relatively expensive compared to the start of the move. Anything below the 50% line is the discount zone. It's relatively cheap.
So this gives us a really clear, almost mechanical rule for filtering entries, doesn't it?
Absolutely. The rule is simple but powerful. You should only look for buy setups, like hitting a bullish OB or FEG, when the price is retraced into the discount zone, below 50%. And you should only look for sell setups when the price is rallied into the premium zone, above 50%. It sounds basic, but it forces incredible discipline. It stops you from chasing price high or selling low in panic.
It forces you to wait for that pullback, for the better price. If you try to buy way up near the top, say only a 20% pullback into premium.
Your stop loss has to be huge to be safe below the swing low, right? And you're incredibly vulnerable to that inevitable deeper retracement back towards equilibrium, or even deeper into discount, which is likely where the institutions are waiting anyway.
Okay, so within those discount and premium zones, we then look for the best prices. This is where the optimal trade entry or OTE comes in. What makes these specific Fibonacci levels like 0.62, 0.71, 0.786 optimal?
Yeah, the OTE zone usually refers to that deeper part of the discount or premium area, typically between the 61.8% or 0.62 and 78.6% or 0.786 Fibonacci retracement levels. Some also use the 70.5% plus 0.71 level heavily. Why optimal? Well, a couple of reasons. First, from a risk perspective, entering deep in discount for a buy allows you to place a much tighter stop loss just below the swing low, giving you a potentially massive risk-to-reward ratio if the move plays out. But perhaps more importantly, there's a strong belief, supported by observation, that institutional algorithms are often programmed to execute significant portions of their orders within these deep retracement zones.
So you're suggesting there's almost a mechanical reason tied to how institutions execute for why these specific numbers often act as strong reaction points.
That's the idea. Think about it. Getting price back to the 70% or 78% retracement level is a significant discount from the recent high. For institutions needing to fill massive orders, possibly averaging into a position, these deep levels offer the best possible entry price, minimizing their risk before they expect the next major expansionary move to begin. You're essentially trying to get in alongside them at their preferred price point.
Okay, so the ultimate high probability setup emerges when all these layers align. You need a PD array, like a clear FVG or OB, but it has to be situated within that OTE sweet spot, inside the correct premium or discount zone, after a confirmed structural event like a BOS.
That's the confluence. That's the secret sauce, really. You're not just trading one signal. You're stacking the probabilities in your favor. You've got the market structure telling you the likely direction. You've got the premium discount context telling you when to look for an entry. And you've got the PD array giving you the precise where, when all three align. That's your A-plus setup.
Excellent. Let's move into section 5 then, looking at some powerful dynamic price action patterns. The first one is the power of 3, also known as AMD. This seems to describe a daily or session cycle.
Yeah, AMD stands for accumulation, manipulation, and distribution. It's a model that describes a common cycle of how price action unfolds, often aligning really well with the major trading sessions. Think Asia, London, New York.
Okay, let's connect those phases directly to the sessions because that makes it very practical for listeners trying to time their analysis or entries.
Right, so accumulation A is typically the first phase. It's usually a period of consolidation or range-bound movement. This often happens during the relatively quiet Asian trading session. Price establishes a high and a low for the session, the Asian range. Volume is generally lower. Smart money might be quietly accumulating initial positions, but they're not really showing their hand yet, often just taking out liquidity within that range.
Okay, the quiet before the storm. Then comes the manipulation M phase, the trap.
Exactly. Manipulation typically kicks in around the London session open, sometimes a bit before or after. This is the shakeout phase. Smart money gets aggressive here. They'll often drive price outside the established Asian range, specifically to sweep the liquidity that's built up above the Asian high or below the Asian low. This move often looks like a breakout or a breakdown, tricking retail traders into thinking the trend is starting, when really it's just a stop hunt before the real move.
So that manipulation move is often that sharp wick we see that pierces the high or low of the range, then quickly reverses.
Very often, yes. And then finally comes the distribution D phase. This is the payoff. Distribution is the strong, often fast directional move in the true intended direction that smart money wanted all along. This expansionary move frequently starts with force during the London session and can continue right through the New York session. For traders, especially beginners, focusing on catching this distribution leg is often the highest probability play. The direction is usually clearer after the manipulation has occurred.
So let's say the market accumulated in Asia, then manipulated above the Asian high, taking out buy stops, signaling a likely bearish day. How would someone look to enter that distribution leg downwards?
Good question. If the manipulation took out the high, your bias is now likely short. The distribution candle will be the strong down move that follows. You typically look for that distribution candle to start forming, maybe pull back just slightly, often into a small order block or FEG created by the manipulation wick itself, and you'd look to enter short there, maybe just above the candle's opening price, anticipating the continuation downwards. You're essentially using the confirmation of the manipulation, the stop hunt, to position yourself for the real move. And remember, like everything else, this AMD pattern is fractal. You can see this accumulate, manipulate, distribute sequence play out over the course of a single daily candle sometimes. The opening price sets the stage, the wick might represent the manipulation, i.e. wick above the open, and the closing price relative to the open shows the distribution, for example, closing lower. Or it can happen over 2 candles, or the classic 3-session pattern. The underlying principle remains. Range, hunt, run.
Got it. The sources also mention something called candle range theory, or CRT, specifically as a way to filter trades using range patterns. How does this differ from AMD?
CRT is really a specific filter focused on very obvious range patterns, often emphasizing that 3-candle AMD structure when it's particularly clear. The main point from the source material was, look for a clear, undeniable range. Don't try to force it. If the accumulation phase is messy or ambiguous, if the range isn't clean, just skip it. Wait for a high probability setup.
So it's about selectivity. And the entry model for CRT, is it similar to AMD?
Very similar, yes. Once you have that clear range accumulation and the second candle manipulation clearly soups or breaks the high or low of that range, you then look to the third candle distribution for the entry signal. Often this involves waiting for that third candle to retrace slightly back towards the origin of the manipulation move, maybe hitting an order block or an OTE level created during the second candle sweep before you enter in the direction of the expected distribution. Again, you're entering on that retest of the turning point, anticipating the strong follow-through.
Okay, fantastic. We've built the whole framework: structure, liquidity, precise entry zones within premium discount, and even dynamic patterns like AMD. Now, Section 6 is about confirmation tools, things that give us extra confidence that smart money is indeed involved, and a reversal or continuation is likely. The SMT divergence seems key here.
Yes, SMT divergence, Smart Money Tool divergence, is a really powerful confirmation indicator. It works by comparing 2 assets that are normally highly correlated. Think, for example, Euro USD and GBP USD. They usually move in the same general direction because both are heavily influenced by the US dollar. Or maybe 2 stock indices like the NASDAQ and the S&P 500. The power comes when this normal correlation breaks down, especially at a key price level. When they don't move together at an extreme, it's like smart money is leaving a clue.
What specifically are we looking for in that breakdown? How does the divergence manifest?
You're looking for divergence right at a potential turning point, a significant high or low. For example, let's say both USD and GBP USD have rallied up to a resistance area. Then USD pushes up and makes a new high, clearly breaking the previous peak and taking liquidity above it. But at the same time, you look over at GBP USD and it fails to make a new high. It might make a lower high instead. That failure of the correlated asset, GBP USD, to confirm the new high made by the other asset, USSD, that's SMT divergence.
Okay, I see the pattern, but why does that divergence signal an impending reversal? What's the logic behind it from an institutional perspective?
The interpretation is that smart money is treating the 2 correlated assets differently at that key moment. Maybe they are selling heavily into the strength on the pair making the new high, USD, while perhaps accumulating buying shorts more quietly on the pair that's failing to make the new high, GBP USD, or vice versa. It essentially shows an institutional preference or manipulation. The fact that one pair takes out the liquidity, makes the new high low, while the other fails, suggests that the move is not universally supported and is likely engineered. The pair that did take liquidity is often seen as having completed its objective before the reversal.
That leads to a crucial point. If you see this divergence, how do you decide which of the 2 assets to trade? If USD made the new high and GBP USD failed, and you expect both to reverse downwards, which is the better short?
Generally, the thinking is that the asset that took the liquidity, Euro USD in our example, by making the new high, is often the one that will move more cleanly or strongly in the reversal direction. It's completed its mission of grabbing stops. The asset that failed to take liquidity, GBP/USD, might be considered weaker and might lag or consolidate more during the reversal. So if looking to sell after a bearish SMT divergence at a high, you typically favor shorting the pair that made the higher high.
Got it. And we should also mention the special case involving the DXY, the US dollar index. How does that fit in?
Right, the DXY correlation is a bit different because the dollar index generally moves inversely to major pairs like USD or GBP/USD. When DXY goes up, USD tends to go down and vice versa. So with DXY, you're looking for SMT divergence where this inverse correlation breaks down at key levels. For instance, if USD is pushing up towards a major resistance level, a potential high, you expect the DXY to be pushing down toward a major support level, a potential low. If, at that point, USD makes a new high but the DXY fails to make a new low and makes a higher low instead, that's a powerful bearish SMT signal for USD. It's like the dollar itself is refusing to confirm the euro's strength, signaling an impending reversal. It's a double layer of confirmation.
That makes sense. Okay, let's use this final part to really synthesize everything and emphasize that core concept, the fractality of the market.
Yes, this is perhaps the most profound aspect of these concepts. They are universally applicable because the market is fractal. What that means is the same patterns, the same rules of structure, liquidity, premium discount zones, order blocks, FVGs, even AMD. They appear and function in the exact same way across all time frames. Whether you're looking at a monthly chart, a daily chart, a 4-hour, a 15-minute, or even a 1-minute chart, the underlying principles of how price moves are consistent.
So this isn't just about picking one time frame. A sophisticated trader uses this fractality to their advantage, right? How does that work in practice?
Absolutely. You combine time frames for a multi-layered analysis. This is often called top-down analysis. For example, a swing trader might start on the daily or 4-hour chart. They use this higher time frame to establish the overall market structure and bias. Is the main trend bullish or bearish? Where are the key higher time frame swing points and PD arrays? Once they have that higher time frame picture, let's say the H4 trend is clearly bullish, then it'll drop down to a lower time frame, like the 1-hour or 15-minute chart. They use the lower time frame to look for the precise entry setup, maybe an M15 order block or FVG, but only if that setup aligns with the higher time frame bias and occurs within a higher time frame discount zone, like the H4 OTE. You're using the big picture to filter the small picture signals.
That's the key then. Using the higher time frame as the map to navigate the noise on the lower time frames. Don't fight the larger flow.
Precisely. Don't look for a 5-minute buy setup if the 4-hour structure is clearly bearish and prices in a premium zone. Always align your entry time frame with the analysis of the higher time frame context. That confluence across time frames is where the highest probability setups lie.
This has been incredibly insightful, a real deep dive into seeing the market through an institutional lens. Just to recap the core pillars, market structure gives us the trend and bias. Liquidity explains why price moves, it's the fuel. PD arrays, like FEGs and order blocks, give us those precise zones for potential entries. And all of this has to be framed within the crucial context of premium and discount zones.
That's a great summary. And while understanding this theory is absolutely essential, the listeners need to remember that knowing it isn't enough. Profitability comes from disciplined execution, consistent application, and really rigorous risk management. Your job isn't to trade constantly. It's to patiently wait for those A-plus setups, where all the elements we discussed align the confluence. Develop a checklist based on these concepts. Don't chase price, don't give in to FOMO. Wait for the market to come to your predefined levels, confirm the structure, and then execute your plan.
Okay, let's wrap up with that final provocative thought for everyone listening to consider. What's the ultimate setup they should be looking for?
The highest probability setups, the ones you should really wait patiently for, almost always occur under these conditions. You have a clear high time frame break of structure. Price then makes a deep retracement back into a discount for buys or premium for sells zone on that higher time frame. Within that zone, price taps into a clear higher time frame PD array, like an H4 order block or daily FEG. And crucially, as price arrives at that zone, you see confirmation on a lower time frame, maybe a lower time frame structure shift, THOCH, a clear liquidity sweep just below above the level, or confirming SMT divergence. When you get that perfect storm, high time frame structure, high time frame PD context, a clear high time frame zone, and lower time frame confirmation of entry, that's when the odds are overwhelmingly stacked in your favor. That's when you trade with institutional backing. Wait for that confluence.